David Zervos, he's the chief market strategist at Jefferies. So, David, is a day like today a sign of progress?
I think it's a sign of the process moving forward. It's not a pleasant process, as you and I have discussed, Kelly, now for many months. And we just have to kind of, get through it. It's a painful withdrawal of stimulus. We're all very used to stimulus. Stimulus is fun. Stimulus is nice. It cushions us. And when we take it away, markets get a little bit jittery. And that's what we're feeling now. And I think it's all very much to be expected. But, things can go wrong. Things can also go right. It's a tricky time for the market. I really think there are some silver linings that maybe we should talk about. But
sure.
Generally speaking, this is sort of what you would expect with QT and higher rates.
Give me some silver linings, because we could certainly use some right now.
Yeah, I thought that would be fun today, rather than try to beat the dead horse when it's almost dying. Look, inflation is as nasty and as evil as it is, and as redistributive as it is. It has some other potential benefits that we should think about. One is we look at debt to GDP ratios. Last year, for example, nominal GDP grew at 12%. The highest since 1983, which makes our debt sustainability look a lot better. We usually grow nominal GDP about 4 or 5% a year, 2 real, 2 inflation. We were at 7 inflation and 5 real. This year we may be 5 and 3, 6 and 2. We could be another 8% nominal. That really makes debt get devalued, which is positive for balance sheets. It also changes asset valuations. The Buffett statistic is something we always look at, Kelly, which is the total value of the equity market divided by nominal GDP. When nominal GDP is growing really fast, everything looks a little bit easier on the eye, because we have the income, the nominal income, to support that nominal valuation. So right. I don't want to get everybody too excited about, yay, inflation's great. But there are some things that inflation does, particularly for a highly levered economy like the United States, with a lot of debt and a lot of focus on assets, that can be quite an elixir, as long as the Fed keeps long-term inflation expectations under control, which they have done when we look through to the break-even markets.
Well, what you just brought up as a silver lining is for others a big worry spot, because they worry, what if D.C. basically sort of thinks to itself, okay, maybe we don't really want to tackle inflation, because that would send the economy into recession. And if we let inflation go a little bit, hey, it'll be easier to pay down our debt. Look at Treasury receipts this year. I mean, that's a very dangerous game to be playing, isn't it?
It is. And as I said, I caveat at the end of that, and you're very, very correct in pointing that out. And this is a very, there's a fine line that you're drawing here. The Fed has to always maintain the credibility of its commitment to long-term inflation at or around 2%. To the extent that it gets these big jumps up but maintains credibility, that's actually a really positive story. Much better than a disinflationary or deflationary outcome, where a highly indebted society that goes into a big deflationary period starts to really squeal, as we've seen for 30 years in Japan. We don't want to do that. So the Fed has to maintain this long-term credibility. It has done it. I believe it will continue to do it. Jay has been doing, I think, a great job of warning about how tough this is going to be. But we may get through this with inflation expectations well contained, particularly 5-year and long-term inflation expectations, and some kind of elixir of higher inflation than usual that makes some of those balance sheet issues go away a little.